Srinivasan Subramanian, Managing Director and Head of Institutional Equities with Axis Capital, joins us. Well, if I introduce him as Srinivasan Subramanian, our viewers will not recollect, but if I simply say that Dr. Subra joins us, everyone will remember him. Dr. Subra, good morning. Thank you for joining us. It's great to have you back.
Hi, thanks. Good morning and thank you.
What do you make of this Moody's downgrade? You know, I'm sure at the conference somebody will ask you this question that, oh my God, why are rating agencies reacting the way they are reacting? I mean, a downgrade for India? India is in the same bracket as Bulgaria, Colombia, Indonesia and Philippines.
I think, we all know that rating agencies do their job a little later, a little slower, but markets are ahead. Rating agencies look in the rear view mirror, markets are looking ahead. I think that's a fundamental difference.
So you will not pay too much of attention to what rating agencies have to say. I mean, I'm just trying to get that from you.
I'm not being flippant and I'm not downplaying the gravity of the situation down in India now. I think that the situation is reasonably dire as the first quarter GDP numbers came out. I think the second quarter numbers were going to be broadly in the same range as the first quarter numbers. But however, I think that what is the market looking positively is that the government has responding and the government is responding at multiple levels across the entire spectrum, not just in terms of corporate rate cuts, not just in terms of what they announced day before in terms of their real estate, getting them real estate out of the jam, not just in terms of India going slow on RCEP, but I think the whole sort of thing that the government is saying that economy is important and economy is something that they will focus on. It might take a couple of quarters for all the effect of these measures to come through. But I think that what the rating agency is talking about is today. I think the markets are talking about is tomorrow.
Yeah. But in the near term, do you feel, Dr. Subra, that there are challenges, or would you say that we are out of the woods, those August lows are way behind us, and we will not get back to those kind of lows in the near term at least?
I think that the bottom is made. It will take a couple of quarters for us to completely get out of the woods. I think that the consumption part of it, we would still expect some the auto companies to get a little bit pass on entire tax rate cuts, which they will benefit from. They will also have been having excellent ROEs over the longer term. I think that on a core ROE basis, many of the companies are in the 25-30% plus. I think if they come to 20% levels, they can pass on a further more price cuts, and that is going to help revive demand. So I think that the bottom is done. I don't think we will go further below this. However, it might take a couple of quarters for everything to gather steam.
Okay. The high frequency data is still mixed. I can argue about Amazon sales and Flipkart sales doing well, but car companies are saying, look, we are feeling the heat because of BS4 emission norms, and there is a drop. If I look at mall footfalls, mall footfalls have been strong, but apparel companies and food companies are complaining that they had a very muted Diwali. What is the right data point one should look at, which will tell us the true picture of where economy, earnings, and the markets are headed?
I think the data point one should look at is clearly the sales across different industries is something one should look at it. It is not only one. Flipkart alone, it doesn't give you the sense. Neither does the Maruti sales alone give you the sense. I think the broader market, you will see the consumption, the staples will move up a little quicker.
I'm not sure that this is good.
What is that? Guys?
To see pricing falls come through.
Dr. Subra, pardon me, I think there is a bit of an audio leak here, happens, when it rains in Bombay. So in case you're wondering that whom you're able to hear, well, that's my next guest. Just bear with me for 10 seconds. I'm just going to get a clearance from my PCR that the audio is going clean, and I'm just coming right back to you. Okay, I can come back to you. Dr. Subra, the other conversation which has been part of narrative for a lot of us has been, how should one understand what is the right price to pay for some of these great businesses like a Bajaj Finance or a Asian Paints or an HDFC Bank? These are the companies where growth is, they've done exceptionally well in a difficult environment. So for an investor who's a true blue value investor would say, great company, bad price. But this argument, frankly, in last 2 or 3 years has made money. For those who bought quality stocks at any price, they are the ones who are outperforming and the NAVs are looking strong. How are you defending, or what is your thought on this very popular debate on Reed Street right now? Value versus growth, quality versus premium.
I think that it is not either or. I think that the Indian markets, if you look at it over a long period of time, has paid for growth. So growth at a reasonable price is what one should look at it. It's easy to talk about HDFC Bank and Bajaj Finance and say that they are very, very expensive. Bajaj Finance at about, post the fundraise, it's somewhere around about 7 times current year and probably 6 times in FY21. But however, if you look at on a PE basis, both Bajaj Finance as well as HDFC Bank are at less than 1x PEG. And I think that's an important element to look at it. Have these companies been able to grow their earnings and keep quality of assets intact? I wouldn't look at earnings for companies in the financial sector if the asset quality was not good. But these two companies have been able to show that irrespective of market cycles, they've been able to contain risk and contain the asset quality to the best of their assets. So I would look at that. If you look at Asian Paints, on the other hand, on a PEG basis, it is significantly higher than 1. Therefore, I ask myself the question, if I invest in Asian Paints, what is my ROE, and not the company's ROE, what is my ROE on the price I pay? And I think that I'm starting to ask myself those questions. Therefore, for us, the private banks, good quality companies like Bajaj Finance are all still in the buy zone. However, if you take a company like, the paints which you talked about it, if you talk about Nestle, Lever, I am asking myself question that in the long term, does it give me an IRR at the level from where I invest over the next 5 years, 7 years, even if I take a longer term, unless the revenue jump is going to be significantly larger, I might end up getting a single-digit IRR. And do I want to own companies, however good they are, with single-digit IRRs? But in Bajaj and in HDFC, I see double-digit IRRs, 15, 17, 18% stock price IRRs over the next 3, 4, 5, and even longer horizon.
Though, Dr. Subra, would you not say that similar is the concern with some of the insurance plays as well? The most sought after trade in town for the last 1 year almost, up until, ICICI Bank and Axis of the world came into limelight. And the problem being that the growth as well as the price multiples that these stocks are trading at, they're just not coinciding. I mean, one is wondering this morning whether it's time to really take chips off the table when it comes to insurance. It's been a very strong run up in, the entire cluster, and you wonder whether these kind of growth multiples can really go on in the near term or not.
I think that if you look at the insurance sector, the reason why the market is extremely positive about the insurance sector, and I should caution you that right now as Axis Capital we cover only SBI Life Insurance. We don't have coverage on the other, but on a generic basis I would say the runway for growth for the insurance sector I would say is extremely strong over the next 10, 15, 20 years. And same is the case with asset management companies. On paper, these look extremely highly valued, but can you see an extremely long runway for growth for these sectors and these companies? I think definitely yes. And that's the price which the market is willing to give for growth. Like I said at the beginning, Indian markets is a growth oriented play. It is not necessarily a value play. Growth at reasonable price. And I think that that's what one should look at it in India.
What's your thought when it comes to the auto space, and also which side of that debate would you lie on? Would you prefer, for example, auto ancillaries, or prefer to look at the sector in a different way?
I think I would rather play the auto through the auto ancillaries, because the auto ancillaries are definitely and are able to get some of the good quality ones are able to get a better increasing wallet share. So while auto growth itself is cyclical, will pick up after the disaster in the first 6-8 months so far, the auto stocks will the growth will pick up, but I'd rather play it through the ancillaries because I am still not sure over a 5-7 year period how the EV is going to impact the existing ones. So I'd rather play it through the ancillaries. And the ancillaries that are not going to be impacted by the IC engines going off. And those are the ones I would like to be working with.
Dr. Subra, appreciate your time and thank you for joining us. Haven't met you personally in a while also. So I look forward to meet you for a cup of coffee also very soon.
Sure. Definitely, we should sure meet up. And thank you very much for calling me.